Investing in the stock market is fraught with risk. The risk level in stock investment is relatively high, but should that discourage us from investing? I would say no, we should not get discouraged. That's why I want to consider this video, the ultimate guide to managing risk in the stock market, the ultimate guide to managing risk in the stock market. So here are some key stock market risk management techniques that will minimize your risk, that will mitigate your risk. Number one is diversification. When it comes to diversification, it involves spreading investment across different asset classes, sectors or regions or industries to reduce the impact of poor performance in any single investment. A diversified portfolio can help it can smooth your returns and as well as lower your risk. When you invest in different classes of assets, different asset classes, you invest in different industries, sectors, or regions. Once you are adequately diversified, your risk is reduced to the barest minimum. So if a particular investment underperforms, it will not affect the returns of the overall portfolio compared to investing in a single or few stocks or in a single or few sectors. Number two is asset allocation. Asset allocation, you decide how to distribute your investments among different asset types. It might be stocks, it might be bonds, it might be real estate, cash, commodities, whichever one, based on your risk tolerance. So investment is based on how you are able to tolerate risk, your risk tolerance, as well as your investment goals and your time horizon. How long do you want to hold your investment? Is it a short-term investment? Is it a long-term investment? That will determine your asset mix in the portfolio. So rebalancing the portfolio regularly can equally help to maintain the desired allocation. You rebalance regularly, you sell what needs to be sold and add to what needs to be added to. So number three is position sizing. When it comes to position sizing, you determine the amount of capital to allocate to each individual trades or investment based on your risk tolerance and portfolio size. This ensures that no single investment jeopardizes the overall portfolio. You may say, well, let's take a hypothetical portfolio. Let's say you have $100,000 you want to invest, and you have 50, and you have 10 stocks you want to invest in. You can simply divide your money by 10, and you put $10,000 per stock. So that's what is called position sizing. This is an equal position and position size in that portfolio. And so you don't just put your entire money in one or two or three. You tend to it's advisable you spread the amount across a sizable number of stocks or positions. Number four is stop loss orders. Stop loss orders has to do with setting a predetermined level at which you will sell your security, to limit losses. You simply set a particular limit. Let's say $5 or $10. So the stock cannot fall below $10. Once it gets to $10, the system will automatically sell your position so as not to incur further losses. A stop loss order automatically triggers a sell if the stock price falls to a certain point, preventing excessive losses in that position. Number five is risk-reward ratio. Risk-reward ratio. Before entering a trade, evaluate the potential reward relative to the risk you are taking. A common ratio of 2:1 means that the potential reward should be twice the risk of the trade. Let's say you bought a stock at maybe let's say $10. Okay, And the risk reward is 2:1. That means you can make 2%, you can make 20% on the upside, that's $2, and you can make 1% in the downside, that's $1. So you are able to like obtain a favorable risk reward ratio. This helps in making a more disciplined, making a more disciplined, taking a more disciplined decision. You ask yourself, what is my risk level, or what a level of losses can I tolerate in this particular position? So if the answer is favorable, you go ahead and invest. That is, your upside potential should be twice as much as your downside potential. So you can invest based on that particular parameter. Please like this video and subscribe to this channel if you've not done that. Number 6 is hedging. When it comes to hedging, you use derivatives, that's options and futures. These are complicated instruments anyway. It is meant for sophisticated, experienced, and highly capitalized investors. Use it to offset potential losses in other investment. For instance, buying put options on stocks you own can protect against significant decline in their value. You want to hedge against decline in your stock value, you can purchase a put option. Number 7 is volatility control. Volatility control. So monitor the market volatility through index like the VIX, the VIX, that's the volatility index, and adjust exposure accordingly. In a high volatility environment, reduce exposure to risky assets, or moving to safer assets like bonds to mitigate your risk. So once the market is highly volatile, when you use the VIX index or the volatility index as a parameter, if the volatility is too high, you can shift an investment to a less volatile instrument like bonds and treasury bills and commercial papers and other related investment vehicles. Number 8 is a regular review and adjustment. So you review your portfolio regularly, to be able to, adopt the portfolio to changing market conditions, personal circumstances, and investment goals. It's necessary. You carry out rebalancing, readjustment of the portfolio from time to time, so that you'll be able to take care of your personal preference or circumstances and to be able to adjust to the market conditions. So keeping your portfolio aligned with your objective help reduce exposure to unforeseen risk. Number 9 is position monitoring and active management. Position monitoring and active management. So you continuously track the performance of your investment, especially during periods of market volatility. Proactive adjustments can prevent large losses if the market drifts or if the market trend shifts. When you adjust your portfolio, you monitor your portfolio regularly, almost like maybe on a daily, on a weekly basis, you are able to make adjustment based on market trends so as to be able to reduce losses that may occur in the portfolio. Number 10 is limit use of leverage. You limit the use of leverage. Why leverage? That's leverage here means borrowed money. Can amplify gains. It can also amplify your losses. All right, and so limiting the use of margin trading or borrowing money to invest can prevent catastrophic losses in a volatile market environment. And so once the market is highly volatile, you don't borrow too much on margin. You don't trade too much on leverage. These techniques can help protect your portfolio from unexpected market swings while striving to achieve your portfolio goals at the end of the day.